Question 1. In New York, an individual life insurance policy must include a free look period. What is the minimum duration for this free look period from the date of policy delivery? A. 5 days. B. 10 days. C. 15 days. D. 30 days. Answer: B. 10 days. New York law mandates a minimum 10-day free look period for individual life insurance policies, allowing policy owners to return the policy for a full refund of premiums paid if they decide against it. This period begins when the policy is delivered, not when it is issued or applied for, giving the insured ample time to review the contract terms. For example, if a policy is delivered on June 1st, the insured has until June 10th to return it for a refund. Always remember that the free look period is a consumer protection measure designed to ensure satisfaction with the purchase. Question 2. According to New York insurance law, if an insured misstates their age on a life insurance application, what action will the insurer typically take upon discovery of the misstatement? A. The policy will be immediately voided, and all premiums forfeited. B. The policy will be rescinded, and a portion of the premiums returned. C. The death benefit will be adjusted to the amount the premium would have purchased at the correct age. D. The insurer will charge the insured for the difference in premiums plus interest. Answer: C. The death benefit will be adjusted to the amount the premium would have purchased at the correct age. The misstatement of age provision in New York life insurance policies dictates that if an insured's age was incorrectly stated, the death benefit will be adjusted to what the premium paid would have purchased at the insured's true age. This provision protects both the insurer and the insured by ensuring the policy's value accurately reflects the premium paid for the actual risk. For instance, if someone understated their age, the death benefit would be reduced to an amount that the original premium could have bought for an older, and thus higher risk, individual. This clause helps maintain the actuarial integrity of the policy without voiding it entirely. Question 3. Under New York law, which of the following statements is true regarding the incontestability clause in a life insurance policy? A. The insurer can contest the policy only for fraud after 2 years from its issue date. B. The policy becomes incontestable after 1 year from its issue date, even for fraud. C. The insurer can contest the policy for any reason within 1 year of its issue date. D. The policy is incontestable after 2 years from its issue date, except for non-payment of premiums. Answer: D. The policy is incontestable after 2 years from its issue date, except for non-payment of premiums. In New York, a life insurance policy typically becomes incontestable after it has been in force for 2 years from its issue date, meaning the insurer cannot deny a claim based on misrepresentations or fraud in the application after this period. The only exception to this incontestability is for non-payment of premiums. An insurer can always deny a claim if premiums were not paid. This clause provides security for the policy owner, ensuring that once the 2-year period passes, the validity of the policy cannot be challenged based on application details, offering peace of mind to beneficiaries. Always advise clients that accurate information on the application is crucial from the start. Question 4. In New York, which entity is responsible for regulating variable life insurance policies? A. Only the New York State Department of Financial Services, DFS. B. Only the Financial Industry Regulatory Authority, FINRA. C. Both the New York State Department of Financial Services, DFS, and FINRA. D. The Securities and Exchange Commission, SEC, only. Answer: C. Both the New York State Department of Financial Services, DFS, and FINRA. Variable life insurance policies are considered both insurance products and securities, thus requiring dual regulation in New York. The New York State Department of Financial Services, DFS, regulates the insurance aspects, such as licensing and policy provisions, while the Financial Industry Regulatory Authority, FINRA, oversees the securities components, including sales practices and investment performance. This dual oversight ensures that consumers are protected from both insurance and securities-related risks. Agents selling these products must hold both a life insurance license and a securities license, demonstrating the hybrid nature of the product. Remember, if a product involves investment risk for the policyholder, securities regulation is likely involved. Question 5. According to New York insurance law, what is the maximum duration for a temporary life insurance producer's license? A. 60 days. B. 90 days. C. 120 days. D. 180 days. Answer: D. 180 days. New York insurance law permits the issuance of a temporary life insurance producer's license for a maximum duration of 180 days in specific circumstances, such as the death or disability of a licensed producer. This temporary license is designed to allow existing business to continue without interruption while a new licensed producer is sought or trained. For example, if an agency owner dies, a family member might be granted a temporary license to manage operations during the transition. This provision ensures continuity of service for policyholders and allows time for proper succession planning. Question 6. A life insurance policy in New York must contain a grace period for premium payments. What is the minimum length of this grace period? A. 7 days. B. 15 days. C. 30 days. D. 31 days. Answer: D. 31 days. New York law mandates a minimum 31-day grace period for life insurance policies, during which the policy remains in force even if the premium is not paid on its due date. This period provides a critical safety net, preventing immediate policy lapse and giving the policy owner extra time to make the payment. If the insured dies during this grace period, the death benefit is paid, minus any overdue premiums. This provision ensures that a policy does not lapse due to a minor delay in payment, offering crucial protection to policyholders. Question 7. In New York, which of the following is considered an unfair trade practice known as rebating? A. Offering an applicant a premium reduction based on a large policy purchase. B. Paying a commission to an unlicensed individual for insurance sales. C. Providing a prospective client with a gift of nominal value after a meeting. D. Offering a prospective client an inducement not specified in the insurance contract to buy a policy. Answer: D. Offering a prospective client an inducement not specified in the insurance contract to buy a policy. Rebating is an illegal unfair trade practice in New York, defined as offering something of value not specified in the insurance contract as an inducement for a prospect to purchase a policy. This could include offering a portion of the producer's commission or other valuable goods or services as an incentive. The intent is to prevent unfair competition among producers and ensure that policy sales are based on the merits of the insurance product itself, rather than external inducements. For example, a producer cannot offer a client a free vacation package in exchange for purchasing a life insurance policy. Question 8. Under New York insurance law, what is the primary purpose of the life insurance company Guaranty Corporation? A. To regulate the solvency of life insurance companies operating in New York. B. To protect policy owners, insureds, and beneficiaries against the failure of an insurer. C. To resolve disputes between policyholders and insurance companies. D. To provide low-cost life insurance to New York residents. Answer: B. To protect policy owners, insureds, and beneficiaries against the failure of an insurer. The primary purpose of the New York life insurance company Guaranty Corporation is to provide a safety net for policy owners, insureds, and beneficiaries in the event that a member life insurance company becomes insolvent. This corporation pays covered claims up to certain limits, funded by assessments on solvent insurers, ensuring that even if an insurer fails, policyholders do not lose their coverage or benefits entirely. For instance, if a life insurer goes out of business, the Guaranty Corporation steps in to pay death benefits or annuity values up to the legally defined maximums. This serves as a vital consumer protection mechanism, bolstering public confidence in the insurance industry. Question 9. A New York resident applies for a life insurance policy and names her brother as the primary beneficiary and her sister as the contingent beneficiary. If both the insured and the primary beneficiary die in a common accident, who would receive the death benefit, according to the Uniform Simultaneous Death Act, if no specific policy provision applies? A. The insured's estate. B. The primary beneficiary's estate. C. The contingent beneficiary. D. The death benefit would be split equally between the primary and contingent beneficiaries' estates. Answer: C. The contingent beneficiary. Under the Uniform Simultaneous Death Act, which New York has adopted, if the insured and the primary beneficiary die in the same accident and it cannot be determined who died first, it is presumed that the primary beneficiary died before the insured. This means the death benefit would then pass to the contingent beneficiary. The purpose of this act is to avoid the complications and delays of having the proceeds go through the primary beneficiary's estate, which would then be distributed according to their will or intestacy laws. This ensures a smoother and more direct payout to the next designated recipient, such as the sister in this scenario. Question 10. In New York, what is the maximum loan interest rate allowed on a life insurance policy's cash value? A. A fixed rate of 6%. B. A fixed rate of 8%. C. A variable rate not exceeding the prime rate plus 1%. D. Either a fixed rate of 8% or a variable rate tied to a recognized index, as specified in the policy. Answer: D. Either a fixed rate of 8% or a variable rate tied to a recognized index, as specified in the policy. New York insurance law allows life insurance policies to offer either a fixed loan interest rate, not exceeding 8% per annum, or a variable loan interest rate tied to a recognized national index such as Moody's Corporate Bond Yield Average. This flexibility provides options for both insurers and policy owners, balancing the need for a reasonable return for the insurer with competitive borrowing costs for the policyholder. For example, a policy might state that the loan rate will be the higher of 8% or the prime rate plus 1%, but New York specifically regulates that it's either fixed at 8% or variable based on a permissible index. Policy owners should always review their policy's loan provisions carefully before borrowing against their cash value. Question 11. Which of the following statements is true regarding a life insurance producer's fiduciary duty in New York? A. The producer is primarily obligated to act in the best interest of the insurer. B. The producer is primarily obligated to act in the best interest of the client. C. The producer is obligated to act in the best interest of both the client and the insurer equally. D. The producer's fiduciary duty applies only to the handling of premiums. Answer: B. The producer is primarily obligated to act in the best interest of the client. In New York, a life insurance producer has a fiduciary duty to their clients, meaning they must act with the utmost good faith and loyalty, prioritizing the client's best interests. This duty extends beyond simply handling premiums. It encompasses recommending suitable products, providing accurate information, and avoiding conflicts of interest. For example, a producer should recommend a policy that genuinely meets the client's needs and financial situation, even if it results in a lower commission. This ethical obligation is fundamental to maintaining trust and professionalism within the insurance industry. Question 12. According to New York regulations, how often must an insurer file its advertising materials with the Department of Financial Services, DFS? A. Annually. B. Biennially. C. Only upon request by the DFS. D. There is no specific requirement to file, but advertisements must comply with regulations. Answer: D. There is no specific requirement to file, but advertisements must comply with regulations. In New York, there is no general requirement for insurers to file all advertising materials with the Department of Financial Services, DFS, for prior approval or regular submission. However, all advertisements, including those for life insurance, must strictly comply with New York's advertising regulations, ensuring they are not misleading, deceptive, or unfair. The DFS has the authority to review advertisements at any time and can issue cease and desist orders or impose penalties if violations are found. Therefore, while not pre-approved, every piece of advertising collateral is subject to scrutiny and must adhere to legal standards. Question 13. A New York licensed life insurance producer must maintain records of all insurance transactions for how many years? A. 3 years. B. 5 years. C. 7 years. D. 10 years. Answer: C. 7 years. New York insurance law requires licensed life insurance producers to maintain complete records of all insurance transactions, including applications, policies, and financial records, for a minimum of 7 years. This record-keeping requirement is crucial for regulatory oversight, allowing the Department of Financial Services, DFS, to audit producer activities and ensure compliance with state laws and regulations. For instance, if a complaint arises years after a policy was sold, these records provide the necessary documentation to investigate the transaction. Maintaining meticulous records is an essential part of a producer's professional responsibility and helps protect both the consumer and the producer. Question 14. What is the primary purpose of a life insurance illustration in New York? A. To serve as a legally binding contract between the insurer and the policy owner. B. To provide a standardized comparison of different policy types across various insurers. C. To show how policy values and benefits may perform over time based on specific assumptions. D. To guarantee future policy dividends and cash values to the policy owner. Answer: C. To show how policy values and benefits may perform over time based on specific assumptions. In New York, a life insurance illustration is a standardized document designed to show how a non-guaranteed policy's values, such as cash surrender value and death benefit, might perform over time under specific hypothetical conditions. It is not a guarantee of future performance but rather a projection based on current assumptions regarding interest rates, mortality, and expenses. For example, an illustration for a universal life policy will project cash value growth based on a current interest rate, but it will also show a guaranteed minimum rate. Its main purpose is to help consumers understand the potential long-term behavior of a policy before purchase. Question 15. In New York, if a life insurance policy is reinstated after a lapse, what is the maximum period from the date of lapse that the policy owner typically has to apply for reinstatement? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer: D. 5 years. New York insurance law typically allows a life insurance policy owner up to 5 years from the date of lapse to apply for reinstatement, provided certain conditions are met. These conditions usually include payment of all overdue premiums with interest, proof of insurability, meaning the insured must still be a good risk, and repayment or reinstatement of any policy loans. For example, if a policy lapses due to non-payment, the insured has a window of opportunity to bring it back into force without having to apply for a brand new policy, which might have higher premiums or new exclusions. Reinstatement is generally preferable to purchasing a new policy, especially if the insured's health has declined. Question 16. What is the primary difference between a revocable and an irrevocable beneficiary designation in a New York life insurance policy? A revocable beneficiary can receive cash value, while an irrevocable beneficiary cannot. B. A revocable beneficiary can be changed by the policy owner at any time without the beneficiary's consent, whereas an irrevocable beneficiary cannot be changed without their consent. C. An irrevocable beneficiary receives a larger death benefit than a revocable beneficiary. D. Only an irrevocable beneficiary has insurable interest in the insured. Answer: B. A revocable beneficiary can be changed by the policy owner at any time without the beneficiary's consent, whereas an irrevocable beneficiary cannot be changed without their consent. The key distinction between revocable and irrevocable beneficiary designations in New York lies in the policy owner's ability to change the beneficiary. A revocable beneficiary can be changed by the policy owner at any time, for any reason, without needing the beneficiary's permission. Conversely, an irrevocable beneficiary has a vested interest in the policy, meaning the policy owner cannot change the beneficiary, borrow against the cash value, or surrender the policy without the irrevocable beneficiary's written consent. For instance, if a divorce decree specifies an irrevocable beneficiary designation, the policy owner cannot later remove that former spouse without their agreement. Question 17. In New York, what is the minimum age at which an individual can apply for a life insurance policy on their own life? A. 15 years old. B. 16 years old. C. 18 years old. D. 21 years old. Answer: C. 18 years old. In New York, an individual must typically be at least 18 years old to legally enter into an insurance contract, including applying for a life insurance policy on their own life. This age requirement aligns with the general legal age of majority for entering contracts. While minors may be insured under policies owned by an adult, they cannot legally purchase a policy for themselves until they reach adulthood. This ensures that the policy owner has the legal capacity to understand and be bound by the terms of the insurance contract. Question 18. Under New York regulations, if a life insurance policy is being replaced, what is the producer's primary responsibility regarding the replacement? A. To dissuade the policy owner from replacing the policy. B. To advise the policy owner that replacement is always in their best interest. C. To provide the policy owner with a notice regarding replacement and compare existing and proposed policies. D. To inform only the replacing insurer of the proposed replacement. Answer: C. To provide the policy owner with a notice regarding replacement and compare existing and proposed policies. When a life insurance policy is replaced in New York, the producer has a strict responsibility to provide the policy owner with a notice regarding replacement form and to accurately compare the existing policy with the proposed new policy. This disclosure ensures the policy owner understands the potential disadvantages of replacement, such as new contestability or suicide clauses, loss of accumulated cash value or favorable premium rates, and surrender charges. For example, a producer must highlight that the new policy might have a new waiting period for certain benefits. This regulation aims to protect consumers from unnecessary or detrimental policy replacements. Question 19. According to New York insurance law, if an insurer issues a whole life insurance policy, what is the minimum non-forfeiture option that must be offered to the policy owner? A. Extended term insurance. B. Reduced paid-up insurance. C. Cash surrender value. D. All of the above. Answer: D. All of the above. New York insurance law requires that whole life insurance policies, which build cash value, must offer specific non-forfeiture options to the policy owner if they stop paying premiums. These options include extended term insurance, using cash value to buy a single premium term policy for the full face amount, reduced paid-up insurance, using cash value to buy a single premium whole life policy for a reduced face amount, and cash surrender value, receiving the accumulated cash value in a lump sum. These provisions protect policy owners by ensuring they do not lose all value in the policy if they choose to discontinue premium payments. Question 20. In New York, a life insurance producer is appointed by whom? A. The Department of Financial Services, DFS. B. The National Association of Insurance Commissioners, NAIC. C. The insurer. D. The insured. Answer: C. The insurer. In New York, a life insurance producer is appointed by the insurer they represent. While the producer must be licensed by the Department of Financial Services, DFS, it is the insurance company that authorizes the producer to act on its behalf and sell its products. The insurer files a notice of appointment with the DFS for each licensed producer it wishes to engage. For example, ABC Insurance Company would appoint John Smith to sell their life insurance policies after John obtains his New York life insurance license. This appointment process links the producer's authority to specific insurers. Question 21. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, allowing the policy owner to vary payments and coverage as needed? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a type of flexible premium adjustable life insurance policy that offers the policy owner the ability to increase or decrease premiums, as well as adjust the death benefit. Unlike traditional whole life, which has fixed premiums, universal life provides transparency regarding mortality charges and interest credits. For example, if a policyholder experiences financial hardship, they might reduce their premium payment or even pay nothing for a period, as long as the cash value is sufficient to cover policy expenses. This flexibility makes it attractive to individuals whose financial needs or goals may change over time. Question 22. In New York, what is the primary difference between qualified and non-qualified annuities? A. Qualified annuities are purchased with after-tax dollars, while non-qualified annuities are purchased with pre-tax dollars. B. Qualified annuities are part of employer-sponsored retirement plans and receive special tax treatment, while non-qualified annuities are purchased individually with after-tax dollars. C. Qualified annuities are always variable, while non-qualified annuities are always fixed. D. Qualified annuities are only available to government employees, while non-qualified annuities are available to everyone. Answer: B. Qualified annuities are part of employer-sponsored retirement plans and receive special tax treatment, while non-qualified annuities are purchased individually with after-tax dollars. The distinction between qualified and non-qualified annuities in New York primarily relates to their tax treatment and funding source. Qualified annuities are typically purchased with pre-tax dollars as part of an employer-sponsored retirement plan, such as a 403(b) or 401(k), and contributions are tax-deductible, with all distributions being taxable upon retirement. Non-qualified annuities, however, are purchased by individuals with after-tax dollars, meaning contributions are not tax-deductible, but only the earnings are taxed upon withdrawal. For example, an IRA annuity is a qualified annuity, while an annuity purchased directly from an insurer using savings is non-qualified. Question 23. A life insurance policy in New York may include an accidental death benefit rider. How is this benefit typically paid? A. As a supplemental income stream for a specified period. B. As a multiple of the policy's face amount if death occurs due to an accident. C. As a waiver of future premiums if the insured dies accidentally. D. As a return of premiums paid if death is accidental. Answer: B. As a multiple of the policy's face amount if death occurs due to an accident. An accidental death benefit (ADB) rider, also known as double indemnity or triple indemnity, provides an additional death benefit to the beneficiaries if the insured's death is the direct result of an accident, as defined by the policy. This benefit is typically paid as a multiple of the policy's face amount, such as double or triple the original death benefit. For example, if a policy has a $100,000 face amount and an ADB rider that doubles it, the beneficiaries would receive $200,000 if the insured dies accidentally. This rider offers enhanced financial protection for unexpected accidental fatalities. Question 24. What is the primary purpose of the National Association of Insurance Commissioners, NAIC? A. To regulate the insurance industry at the federal level. B. To develop model laws and regulations for states to adopt. C. To license insurance producers in all states. D. To resolve consumer complaints against insurers. Answer: B. To develop model laws and regulations for states to adopt. The National Association of Insurance Commissioners, NAIC, is an organization of insurance regulators from all 50 states, the District of Columbia, and 5 U.S. territories. Its primary purpose is to provide a forum for the development of uniform insurance laws and regulations, known as model laws, which states can then choose to adopt. For example, the NAIC develops model laws for areas like privacy, suitability, and market conduct that many states, including New York, use as a template for their own statutes. While it does not have direct regulatory authority over insurers or producers, its influence helps standardize insurance regulation across the country. Question 25. Under New York insurance law, which of the following is considered an unfair claims settlement practice? A. Denying a claim without conducting a reasonable investigation. B. Providing necessary claim forms promptly upon request. C. Paying claims within a reasonable timeframe once liability is clear. D. Offering a fair and equitable settlement amount for a covered loss. Answer: A. Denying a claim without conducting a reasonable investigation. Denying an insurance claim without first conducting a reasonable and thorough investigation is considered an unfair claims settlement practice under New York insurance law. Insurers are obligated to promptly and fairly investigate all claims to determine coverage and liability before making a decision. For instance, an insurer cannot simply refuse a life insurance claim because the death occurred shortly after policy issuance without investigating all relevant circumstances. This requirement protects consumers by ensuring that claims are handled professionally and justly, preventing arbitrary denials.